How about now?
I cannot see your screen.
Really? Maybe someone else could confirm.
Yes, now I can see it.
Or now you can see it.
Yes.
Okay. Sorry about that. I was saying that we'll delve into a very important topic on asset liability management and liquidity risk. Uh, so there's some certain words or there are certain key terms that you need to understand when for you to have a good understanding of this subject. You need to know what an asset is. My understanding, rather,
Excuse me.
yes.
Now the screen is not visible. I can only see a black screen. The screen is not visible.
Let me stop and then try again. And let me know how
Yes.
it's.
Okay. Also, can you go somewhere where it's a bit silent? There's a lot of background noise coming from your end. Tell the people behind to be a bit silent. We cannot see your screen.
Okay. Let me. I've worked on my. Sorry.
Okay, carry on.
All right. Let me present my screen.
Okay.
Let me know if it's visible. Can you see it? Hello? Hello?
No, it's not. It's not visible. Just do what you did the first time.
Still not visible.
Hello? Hello, I cannot see your screen.
Okay, just give me a moment.
Okay, no problem. Sorry for the delay. We're trying to fix the screen. Now we can see it, but I would encourage you to go to the next slide, to the way it was set, because the view is a bit skewed. Or maybe try to go to the next slide. Okay. I would encourage you to use the other view. Sorry, it's fine. It's fine as it is. Yeah, the presenter view is okay. So carry on, Billy. Hello, Billy. Now we cannot see anything.
now you can see. Sorry, I was on mute. So I was actually just asking which slide you can see.
No, we cannot see anything. Kindly try to close the sharing option and then open it again. Or maybe you can.
How
No, we
about
cannot
now?
see anything. Or just send the screen,
Really?
the slides to me, and then I'll share
Yeah,
on
I
your
can
behalf.
send it.
Yeah.
All right, that's okay. Sure, I think that's okay.
Okay.
You can chat me your email so that I can send to you.
Okay, I'm sending the email right now. To everyone in the chat, please be patient. It's just a technical.
Billy, you can share your slides with Moses so that he can present for you. He can share the screen on your behalf.
I have sent. I've sent to you an email, so you can just. I want you.
Okay, I've received them. I'm sharing them right
All
now.
right. Oh, okay.
Can you see my screen? Can you see my screen? Hello, can you see my screen? Can you
Share
see
the
my
slides.
screen?
Yeah, we can see the Zoom screen, but share the slides.
And now, can you see the screen? Hello.
Sorry, no.
Not yet.
We can't see,
Loading.
can't see anything.
And how about uh,
Moses, I'll be ready when you are.
I'm trying to share, so just be patient. 1 minute, please, because I think the network is a bit down. Hello, can you see the screen?
Yes, we can, but it's not showing the slides. Check with Clinton if you can give him a copy of the slides to help share for us. I think the slides are back, but if you're still having issues, anytime you click on the second browser, the slides disappear. So we are currently, yeah, so just keep, no, go back to the other browser, the other tab, the asset liability tab. Moses, the other tab, just click on the other tab. You can use PowerPoint if the hi, Moses.
Yes, I've
Yes, we can see your
slides with
screen.
Clinton.
We can see your screen. Come again.
I've shared the slides with Clinton.
Okay.
Yeah. So the issue is the network here at the office. So just a minute. Hello. Now, can you see the screen? Hello. Anyone to confirm they can see the screen?
Yes.
Yes,
Okay.
we can see it now.
Yes, you can see.
Thank you for your patience. Okay. So, Billy, over to you.
Okay, confirm you can hear me.
Yes, I can hear you.
All right, so thank you so much, and sorry for the time that we have lost. So I'll just brush through this very quickly. Asset and liability management and liquidity risk. So these are very important subject if you're running a business, or even it applies to you as a person, because I believe as a person you should be running yourself like an entity. You have cash, you have money, you have assets, and you have liabilities as well that you need to know how to manage for you to be healthy financially. So there are certain terminologies that are very important for us to understand, even as we go through this subject. I prepared this. I know this could be simpler, especially to those who are in the School of Business or those who have interacted with business concepts. But because I know our audience is a bit wide, so I thought we also need to brush through key terminologies like asset, liability, cash flow, liquidity, and then asset and liability management. So I know we understand this, some of us, but for some of us who don't understand what an asset is, an asset is anything that has a current or a future economic benefit to a business, to a person. And so it also means also then that you have control over that particular asset. You need to, for something to be an asset to you, you need to have control over it. And then the concept of liability. Liability is an obligation that results in the company's future sacrifices of economic benefits to other entities or to businesses. So a liability is something that you would essentially be paying at some point. You'd essentially be sacrificing a part of your asset to meet it. So liability is like an opposite of an asset. So the concept of a cash flow, it is the net cash and cash equivalents that are transferred in and out of a company. So cash that you receive as a business represent your cash inflows, but the ones that you spend represent your cash outflows. So when you earn money, even as a person, that's a cash inflow to you. When you spend money for whatever reason, that's a cash outflow to you. So and then the aspect of asset and liability management that will be covered in a separate slide, because it's a key element that we're going to discuss in our presentation. So cash flow is very important to a business or to an organization. And so you may ask yourself, why is it important? Why is cash flow very important? Cash flow is very important for you for various reasons, as a business or as a person. This presentation applies to an entity or a business. It also applies to someone as a person. Cash flow is important for you for various reasons. I've listed many of them, but I'll just pick a few of them for our discussion. I know we all relate to this. It's important for your survival and sustainability. You cannot sustain your business. You cannot sustain yourself if there are no cash flows, if you don't have money coming in and money going out. Money coming in is the cash inflow, as I said earlier. Then you need to spend money so that you even access things like basic commodities. Business has things like utilities. They may need to pay electricity, they need to pay rent. So that just explains why cash flow is important. Whether you're making losses or whether you are a profit-making institution, you need to pay certain things. You need to pay utilities, you need to pay rent if you're in a rented space, you need to pay your staff, you need to pay you need to pay for certain services that are offered to you by the service providers. So as a business, as a person, you need cash. And that ties with the operational continuity. So it's business daily business operations are run by cash. There's aspect of the petty cash when you need to even send out a mail or a letter to a client if you wrote a proposal that needs, let's say, physical submission. You need to even pay a rider to take that that proposal to the potential client. So that just explains the importance of cash. As a business or as a person, you'll be making investment decisions, and you'll also be making, you want to grow. I don't think any of us would want to be stagnant in their business or in their personal capacity. So for you to invest in yourself, for you to invest in your business, you'll need the element of cash. You need to buy in assets, you need to buy in furniture, you need to buy in a lot of things. As a person, you need to pay in for your fee to further your studies. So cash is very important at that point. Then cash will also be important for you when you're paying out your dividends. If you're a company, definitely you have shareholders and they'll want to get dividends out of the company. You can't pay that unless there is adequate cash flow. So cash flow is important in that aspect. We are operating, one thing that is certain apart from debt is tax. So we'll be having tax liabilities to, for example, in Kenya, the Kenya Revenue Authority. So you need, for you to meet tax obligations, you'll need to have some cash. That also applies to regulatory compliance. So cash flow is very important. Other importance of cash are, of course, to for expense and invoice management. Of course, you'll always be invoiced. You'll need to pay out those invoices. And also you'll be invoicing. So cash flow is very, very important. And then how do you improve your cash flow? It's a question that I know would come up, and everyone would always want to know how they want to improve your cash flow. So as a business, you will need to improve your cash flow through various means. As a business, you need to track your expenses, the aspect of invoice management and expense control. So you'll be sending out invoices promptly, because sometimes your invoice you give those who owe you money, maybe need to pay in 30 days. So you need, as soon as you offer service, then you need to invoice them so that then they start paying you cash. That will keep you afloat as a business. You also need, sometimes you may need to offer discounts or early payments, especially if it is allowable. If your finance policy allows that, that will ensure that your business is always has cash flows. Why this is important is because, sometimes invoicing customer is not enough. When you do an invoice and they don't pay you cash, at that point there's no cash flow. So when you invoice them and they haven't paid for the service, at that point there's no cash inflow. When you are invoiced and you haven't paid the cash, you haven't paid for the service that was offered to you, there's no cash flow. So that's why it's important sometimes to encourage those who have money to pay money quickly. We offer just a small discount, maybe within a duration of time, so that we can encourage them to pay, and that is very healthy for business. So we need to always offer discounts and for early payments as much as possible if it is allowable. Then when you implement clear and efficient billing processes, of course, that's under invoice management, following up on overdue invoices and considering using invoice factoring or accounts receivable financing. So proper invoice management is very key or essential for us to improve our cash flow as a business. Of course, what every one of us knows, tracking your expenses, taking charge of how you spend as a business. When you're bidding for a service provider, how do you select a service provider? Of course, you want to go for a very expensive one, as long as quality is not interfered with. So as a business, you always need to track your expenses. As a person, you need to track your expenses. You need to do cost-benefit analysis for all your expenditures. It's very important. Whatever you're paying, do you get value for your money? So the concept of time value of money is very important for us to understand. Inventory management, how we manage our inventory, keeping the inventory levels lean to reduce carrying costs is very important. You don't need to have a lot of inventory sitting because they live on taking spaces. And sometimes when you have a lot of inventory, it's not healthy for business. So we need to have things that are coming in and are being sold. So you need to know how to keep your inventory levels lean. Implementing just-in-time inventory system comes in handy. Identifying slow-moving or obsolete inventory and liquidating them helps in proper inventory management. So as a business, as a person, you need to know how to do proper inventory management. Streamlining operations is very important for a business that wants to stay afloat financially. So optimize your business processes to reduce operational inefficiencies. A lot of cash is lost because of operational inefficiencies. The things that you can automate, ensure that you automate. You don't have to employ everyone. I mean, people to do almost everything. So as a business, you need to always optimize your business processes so that you are efficient in your operations and you reduce wastages. I've talked about automating tasks and workflows. They not only save you money, but also they save you time. In business, time is money. So you need to always save as much time as possible. That keeps you in good books with your clients, because then you'll be turning around things quickly. If a business, let's say you're operating in e-commerce, if I order something today online and I get it the very same day, as a customer, I'll be very impressed and I'll want to order with you every now and then. So it's very important as a business to be streamlining our operations. Consolidating tasks and roles to reduce overheads. I've spoken to that. So that's also very important to us or to a business. I hear someone wants to speak or someone is not on mute. Okay, fantastic. That's okay. We can proceed. Working capital management is very essential as well. Extending payment terms with suppliers while maintaining good relationships, accelerating collections from customers, using vendor managed inventory to shift inventory management responsibility to suppliers. Very important. So you need to know how to maintain your working capital. Forecasting your cash flows accurately is very important. You need to anticipate your cash needs. As a business, you need to know what are some of the likely expenses in the following year. How are your revenues expected to grow? Of course, based on various assumptions. It cannot be accurate, but at least you need to forecast your cash flows. The best way to start, or your base figures, could be historical data to forecast future projections. As long as you're a business that has been in existence, as long as you're a business that has existed for a while, then you should be able to have historical finances that will then form a basis for your future cash flows. I doubt you'd be in business for a while and you don't have historical data on your finances. As a person, as a business, you need to have your historical financial data. That's why we have auditors, and auditing is a regulatory requirement for most businesses. So ensure that you have a reputable auditor who can check your books on a regular basis. Debt restructuring is very important. If you're in debt, you can renegotiate for the term loans, or you can refinance high interest debts. You can consider consolidating multiple loans into one to simplify payments, and while you explore options like debt consolidation or lines or letters of credit. So if you find yourself in debt, it's important for you to know how you can restructure your debts to improve your cash flows. The other ways in which you can improve our cash flows, of course, diversifying our revenues. You need to diversify your sources of income. Cash inflow do not only need to come from one source. Otherwise, you'll have concentration risk. Let's say you're in business and you have one big customer, one big client who accounts for, let's say, 90% of your revenues. Your revenues will be highly impacted if they exit or if you lose that client. I know businesses have key clients, but to ensure that you know who are your top 10, top 20, let's say clients, and how do they, what percentage of your total revenues do they bring in, so that you try to diversify that as much as possible to avoid concentration risk. I was explained from that aspect because revenue diversification is majorly understood in having various sources of revenue in terms of, let's say you're a business, so you want to do multiple things. It's also just diversify your customer base. So ensure that your customers are as diverse as possible. You will definitely have some key clients, but they don't need to contribute to more than 50% of your revenue, so that when you lose them, then you lose 50% of your revenue just at a go. You always need to look at your CapEx, your capital expenditure, reevaluate planned capital expenditures to identify cost savings, consider leasing or financing equipment instead of purchasing outrightly. So for facilities or equipment that you can lease, that you don't need to buy outrightly, you can consider leasing them. So it's important for us to reevaluate our capital expenses, our CapEx. It's very important. You need to look at your credit policies to minimize bad debt. Of course, bad debt will always be there, but you need to minimize them as possible. So you need to tighten your credit policy a bit. Of course, also important for us to do as a business is to always have a proper due diligence or screening of your customers and set credit limits. Then regularly review and adjust your credit policies. That will help you avoid instances where you have many bad debtors as a business. Bad debts are not good for businesses. So you need to have a proper look at your credit policy and before you have customer onboarded, you need to do a proper due diligence on the customer. For the assets that you can monetize, you are highly encouraged to do so. You need to sell unneeded or unutilized assets to generate cash and consider leasing out surplus office spaces. Let's say maybe you have an office building that you're not 100% utilizing. You can lease out some spaces to other people that will help you generate cash. And there are also financing options that are available, lines of credit, working capital loans, equity financing to supplement cash flow. Those are options that you can explore. But ensure that when you are exploring financing options, that you are aware of the terms and the implications, what it means for your business. Cash flow statement is very important for us to do regular review on, and it's important for us to know how to prepare a statement of cash flows. Statement of cash flows are very important. And later in the presentation, there's an aspect that will touch on the statement of cash flows as well. But you can go through IS 7, which talks about the statement of cash flows, for you to have a better understanding of how you can, even cash flows are categorized. Very important for us as a business, for you as a business person, entrepreneur, or for you as a person. You also need to focus on retaining your customers and training your employees and to be more efficient. That will save you a lot of cash. It will help you improve your cash flows. So what are some of the types of cash flows that we have? Cash flows, the primary types of cash flows are the 6, but largely actually there are 3 major types that you will, if you are familiar with the statement of cash flows, you will understand, you will know. So there is the cash that comes from the operating activities, cash from investing activities, cash from financing activities. So cash flow from operating activities, these are cash that are generated or used by a company's cooperating activities. You know, as a business or a company has a core activity. If you are, you have a core activity, like why do you exist? Which is are you a sector focused? Are you known for, let's say you're selling cigarettes and tobacco, that will be your core activity. Let's say you are offering training services like Capable, that's your core activity. So cash flow that are generated or used by a company's cooperating activities that are cash. that come from the operating activities. It includes cash from sales, account receivable, operational expenses. Operating cash flows is a key measure of a company's ability to generate cash from its primary business operations. So you need to know how much cash you generate from your operating activities, why the reason as to why you exist. Then there's the investing cash flow as well. It reflects the cash flow related to a company's investment activities, such as buying or selling of assets, investments in securities. Securities could be treasury bills, treasury bonds, or for your capital expenditures. Those are investing cash flows. The positive investing cash flow indicate investments in assets, while a negative investing cash flows represents the investments. So you need to know whether you have a positive or a negative cash flow in each of these, whether from operating, from investing, or even from the third aspect which we are talking about, which is financing activities. So cash flow from financing activities are called financing cash flows. As a company, you could be issuing or repurchasing shares. You could be taking out or repaying loans. You could be paying dividends. So those are cash flow that are generating from financing activities. When you are shareholders, you're repaying them dividends. When you took up a loan that you are repaying as a company, that is like a negative financing cash flow. Or there's three aspects that I thought were also important for us. There's free cash flows, net cash flow, and the gross cash flow. So free cash flow is a critical financial metric that is calculated by subtracting capital expenditures from operating cash flow, and it measures a company's ability to generate cash after necessary investments in capital assets. It's often used to assess a company's financial flexibility. Then there's free cash flow to firm and free cash flows to the equity that you need to have an understanding on, and that I will give as an assignment. Go and read more about it. Net cash flow provides the overall snapshot of a company's cash position by combining the three cash flows that we talked about: cash from operating activities, from investing activities, and from financing activities. So once let's say you have an positive operating cash flow of $1 million, investing cash flow, you have a positive of, let's say, 500,000, and then financing, you have a negative of $1 million. At that point, what will be your net cash flow? It could be plus $1 million, plus 500 minus $1 million. So you get your net financing position. So the gross cash flow refers to total amount of cash generated or used by a business before accounting for deductions such as taxes, interest, and other expenses. It provides a more comprehensive view of cash flow before various financial obligations. So as a business, you'd have certain financial obligations, will be to pay taxes. So the cash flow before such deductions is referred to as the gross cash flow. So it's important to know various cash flows. So we'll go to the aspect of the asset liability management. At the end of the presentation, there will be time for question and answers. So just stay at it. If you have certain questions, you can start. You could be posting them on the chat, or you can ask at the end of the presentation. So asset and liability management is majorly used by financial institutions to mitigate financial risks that result from a mismatch of assets and liabilities. We need to have proper matching of our assets and liabilities, and that is the whole aspect of asset and liability management. So there are certain risks that are mitigated through asset and liability management. Two of them are major. That is liquidity risk and the interest rate risk. We'll do a delve into the two risks, but then there's also the aspect of currency risk and the capital markets risk. So when you strategically match your assets and liabilities, you can achieve greater efficiency in profitability while also reducing your risk. We have talked about the common risks that are addressed by asset and liability management. And the practice of asset and liability management can always include factors that include strategic allocation of assets, risk mitigation, adjustment of regulatory and capital frameworks. And by successfully matching assets against liabilities, financial institutions or actually businesses are left with a surplus that can be actively managed to maximize the investment returns and increase our profitability. So it's very important for us to have a proper matching between our assets and liabilities. So what are some of the examples of asset and liability management risk mitigations? I talked about two major risks: interest rate risks and liquidity risks. These risks are very important for you as a business. So what is an interest rate risk? Interest rate risk refers to risks that are associated with changes to interest rates and how changing interest rates affect future cash flows. So you need to know how changes in interest rates affect your future cash flows and even your current cash flows. Two of the most important common examples are deposits and loans. Let's say you took in a USD loan, and you have seen how a USD loan, USD and the Kenya, like our local currencies, are depreciating. So if you're servicing it using the Kenya shilling account, then just because of the changes or depreciation in our local currency, someone else will be getting more money from you as a business. So those are things that we need to be alive to if you're an entrepreneur. Liquidity risk are risks that are associated with an ability to facilitate your present and future cash flow obligation, also known as liquidity. When a financial institution or an institution is unable to meet its obligation due to shortage of liquidity, the risk is that it will adversely affect its financial position. So liquidity is just aspect where you're able to meet your short-term obligations. You're able to meet your short-term obligations. So if you don't have enough money to meet your short-term obligations as and when they fall due, then you find yourself in a position that is called illiquid. So as a business, as a person, you need to be in a liquidity position where you can meet your short-term obligations as and when they fall due. When you're unable to pay your rent, when you're able to pay your fare to work, when you're able to pay your afford your basic meals, when you can't pay for basic things, you find yourself in an illiquid position. So the other types of risks that can also be mitigated through proper asset and liability management are the currency risks, which are risks associated with changes in exchange rates that we talked about. And when assets and liabilities are held in different currencies, a change in exchange rates can result in a mismatch. So we need to know, you need to be alive to the various exchange rates. How are our local currencies depreciating? On the interest rate risk, in addition, when you take in an obligation, for instance, a loan, and you will be repaying it, sometimes the interest rates can always change. So you need to know how you sign into the terms. Before you sign in, you take in a loan, for instance, whether it's from a SACCO or from a bank, you need to know what's called the cost of capital. How much will it cost you to repay back the loan? What is the interest rate for that obligation? It's very important for you as a person, for you as a business. It's very important. So at this point, I see we have like 6 minutes to 1 p.m. mark, and I'd just like to take in questions, or even if there is an addition from the group, we are happy to learn together. So I hand it over back to us for any questions.
Thanks so much, Billy, for such a comprehensive session. I can see the numbers have grown. First and foremost, thanks so much for being patient with us during the beginning of the webinar. We just had a few technicalities that we needed to sort. This will not happen again. Next Wednesday, everything will be smooth. So someone here called Francis is asking whether you can go over net cash flow components.
All right, thank you for the question. So net cash flow components, it's very simple. Actually, there are two major components for you to get into your net cash flow position. So for you to be at a net cash flow position, you just need to have your total cash inflows versus your total cash outflows. Like how much money is coming into your business and how much money is going out of your business. It could be for whatever reason. Money could come in through maybe your customers are paying, maybe you had you had some savings somewhere that are generating interest for your business. So just by the money sitting in a savings account, it's generating some interest to you as a business. It could be that you invested in a treasury bill or a treasury bond or any security, and so you're getting interest out of that investment. So those are cash inflows. So you, at the end of a period, it could be, let's say within a month, how much money came into you as a business from whatever source. It could even be through a windfall anyway. Then how much how much went out? It could be when you're paying your staff and when you're paying your staff salaries. It could be when you're paying your providers, when you're paying for utilities, you're paying KPLC. It could be when you're paying the Kenya Revenue Authority, some tax obligations that you're paying. It could be even donations that you make. So anything that leaves your business, your cash outflow. So when you have a net of that, then you find yourself at a net position. It's not always all the time that your cash, what is coming in will be greater than what's going out. And that's why I think this presentation was very important. Asset liability management, managing our liquidity. When, if you don't manage your expenses, you will always be in a negative net position. And that is very bad position to be in, because then you'll not be able to meet that's when our liquidity risk coming. You'll not be able to meet, you find yourself in debt. You find yourself to be at a negative cash flow. What you paid out is more than what came in. So when other obligations will fall due, you will not be able to pay them. So that is just the easier way or the simplified method to talk to us on what are the components of the net cash flows position. I hope that helps.
Yeah, that helps. Though you've explained it, I couldn't do a better job. Someone here is also asking, can you talk more about capital allocation? And I'm thinking they don't know like where to put the money. Yeah, just talk more about capital allocation and activities that would generate a higher return on investment.
So capital allocation is the simpler way to explain it is first of all, money, you could call it as your capital. So when you have resources as a person, when you have resources as a business, you will need to allocate them to certain things. It could be in investments. You will need to allocate your money. Resources are always limited. I could have 1,000 shillings. Now I want to spend 1,000 shillings. I don't want to allocate to how much will go to where. Of course, how you spend your money should be based on your strategic plan, or should be based on your strategy. Leave alone the strategic plan aspect, but it could be on where do you want to go into as a business? Where do you see more returns? We would want to put our money in investments that will give us high returns. So that is just like the simple aspect of capital allocation. Once you have seen where you want to go as a business, you will be informed on how you allocate your resources. Let's say you find that, let's say you're a business and you're operating in a what do I call it? Let's say, okay, like e-commerce. Maybe you're in e-commerce. You are in e-commerce, and you find that, let's say you're operating a shop, an e-commerce shop. So you have customers that are ordering businesses. So at the end of a certain period of time, it could be at the end of the year or at the end of the month, when you're recognizing the revenues, you'd want to know which maybe products, for instance, give me more money. Did I find people buying electronics? Did I find people buying food stuff? Did I find people buying clothing? So let's say, for instance, I so many people are spending money to buy clothing. When I'm allocating, when I'm coming up with my budget for the next financial year or for the next period, you don't even have to wait at the end, up to the end of the financial period. You need to be making decisions as regular as possible. As soon as you have insights, then you need to be making adjustments and making decisions. You'll allocate more budget to that revenue stream to go and so that you have more clothes and you get more money. And you'd find that you'll allocate less into areas that don't give you much revenue. So that is just the simple concept of capital allocation. If maybe you find that you are paying a lot of money in rent or in space, and you, based on cost benefit analysis or based on your forecasts and just certain assumptions, you find that having your own space might work for you. So when you're doing your next capital allocation, then you will allocate a substantive portion in trying to address that need. Maybe coming up with, that's a capex. So that is just a simple aspect of it. It's as simple as that. It's not complicated. Let's not complicate issues. Let's understand them in a simple way and then act on them. Normally, when something is complicated, it perhaps means lack of understanding, and then it's difficult to implement. That's the danger. But that is just the simple aspect of capital allocation. Just allocating your resources to the place. It could be, but the resources must not only be in terms of money. It could be even your time. As a person, you'd want to allocate more of your time into the activities that serve you more. You'd not want to spend a lot of your time in activities that take away your energy or that don't add as much value to you. Once you realize that certain thing that adds a lot of value to you, you will find yourself spending more time. So that is just a simple aspect of capital allocation. Over to you, Moses.
Yeah, thank you so much for clearing the air on that. Someone else has a comment. They're asking about innovation and research. So, from my understanding is, should you spend more time on innovation and research and tie that in with risk mitigation? For example, is it smart for you to venture into new products or services, and these new products and services will require a lot of cash upfront or even a lot of cash to make sure they run smoothly? And so is it smart for me to focus my time on innovation and research and kindly tie this in with risk mitigation, meaning I don't want to lose my money trying new things?
Okay, I got it. So what is important for you to know as a business person is you need to understand a company's life cycle. You need to know how cash flows in a company, how they look like. There's a curve there's J. So there's a letter J. Let's say a letter J. You know how letter J is spelled. So when you begin a business, or when a business is in its inception phases, you'd find that your cash flows will be negative because you will just be spending a lot of money and you'll not be already, like, you could already be starting to make money, but the money that you'll be making will not be at par with the money that you are losing. It's when you're setting up a building, you're looking for regulatory things, you're ordering for raw materials. So maybe you haven't had a good capture of the market. So people don't, like, initially, let's say maybe you want to run a clothing business. So in the first month, you'd find you have a negative cash flows in the sense that you have just paid let's say your first 6 months of that rented space. That's a lot of money. You have brought in inventory or stock, clothes they haven't been bought. Then at the end of the month, you find that not so many clothes will go. But even if most of them go, you'd find that the amount of money that you will spend or the cash flow will be at a negative position. So businesses, when they are starting, the curve will always be a letter J. So that's why before you venture into a business, you need to try to understand, you need to forecast how much am I likely to generate. When I put in this money, when I invest this money into a business, what will be the, after how many years? After how many years will I be able to break even? After how many, what is the payback period for this business? How much time will it take me? How many years will it take me for me to bring back my money before I start making money? So when you have that understanding, a business cannot always be. So I'm saying is that when a business is at a negative cash flow, that is not like a very bad sign for a business. It depends on what stage of growth is the company in. When you start a business, it will always be at a negative cash flow. After some time, when you'll have broken even, then you'll find yourself to be in a positive cash flow. So negative cash flows is not necessarily bad, but it depends on what stage is the business in. Now, as to whether you could try innovations, innovation is very important for you to invest in innovations, but again, depends on, before you even try to get into a product, you need to have done a market study. You need to have sized the market sizing. You need to have had your go-to-market strategy. You need to have done your prior research in advance before you venture into any kind of business. Like when you want to, let's say, sell clothes, you can't sell clothes across. There are clothes for small children. I mean, for babies. There are for adults. There, of course, there's also, you need to have done a market research. So innovation is very important for business. And even if your business has been existing for a while, you find that the business environment is keep on changing, and there are always new ways for addressing a problem in the market. So you need to always stay innovative for you to be relevant as a business. So you would spend in some money into business, but then you also need to know how to measure the impact of the amount of money that you spend into innovation and research. You know that it's very difficult to, like, for instance, if you keep on spending money on businesses, on innovation, I mean, not businesses. If you keep on spending money on innovation and you're coming up with new products, but you don't see your cash flow improving, then at that point you'd come to a conclusion that innovation cannot be bad, definitely, but you find that you're not doing it in the right way. Innovation definitely cannot be bad, but you find that you're missing the point. So it's always important for you to monitor your expenses, and always try to, let's say you're in a business that you can measure units, to always attach your total revenues into the number of units that you sell. Let's say your total revenues is 1,000 shillings, you have sold 100 items. So you'd find that not total revenues, but let's say total costs, not even total revenues. Total cost is 1,000, you have sold 100. So you need to know that maybe for every item sold, there's that cost element of 10, which makes 1,000. So you also need to know, are your units improving as you continue to invest in innovation? An example would be, recently I was on a transaction, and you would find that when I looked at the income statement for the client, there were a lot of subscriptions in terms of in softwares. And when I looked at the operational losses, it kept improving. So I was asking the person, why do you invest so much in technology and yet operational losses also keep going high? So when you look at your business from that aspect, as you invest more in technology, do you find that you're reducing on the losses due to operations? Do you think that solution is really working? So I think I would answer it from that perspective, but obviously it's important to innovate. Then sometimes it doesn't work. Business itself is risky. Everything is a risk. Life itself is a risk. So sometimes you make it, sometimes you don't make it. And when you don't make it, I pray that you get lessons and you carry it forward to be better in your next venture.
Nice. Okay, that was a hot question. Last question is, can you give us tips on how we can retain our customers and clients? For example, 2-3 tips.
Okay. of course, customers and clients are the very key. And by the way, even as I answer that question, it's important for you to maintain your customers and clients, because the best way to get business now is not even through advertisement, but through referrals. When you offer someone a good service and they have someone who is looking for the same service, they'll always refer you. Sometimes you don't even have to pay them anything. So ensure that you retain your customers. So then how can you retain them? Customer service is very important, especially if you are targeting the current generation, the Gen Zs. They're very keen on how you treat them. You could have a lot of a lot of very good terms will be more appealing, but how you treat them, how you treat your customer is very important. So customer service has to be top notch, especially if you're in a service industry. You need to offer exemplary service to the customer. When a customer has queries, ensure that you address it urgently or as soon as you can. Be in touch with the customer. So customer service would rank top for me. The other thing will be, of course, favorable terms and conditions. When your business or when your services are not favorable, especially if you are not a monopoly and the quality is just average and it's not similar, it's just similar to what others are producing, are like giving, but your pricing is high, then at that point you may lose some customers, because many customers are price sensitive. And you need to understand your industry. You're in an industry which is price sensitive. Some customers will be willing to pay more just for the class, but many customers are price sensitive. So you need to understand your customers. If you're targeting high net worth individuals, then that may not be a problem. But again, you need to understand who your customers are and what is important to them. Most hustlers are price sensitive, so your pricing need to be correct. And for you to have good prices, then you need to know how you can lower your cost of production. You need to get the best deals in the market as possible. You need to get best supplier as possible. Those who supply you. Of course, you can't produce a good at 100 shillings and you sell it at 90 bob just so that your pricing. That means you'll be running a loss of 10. So pricing is very important. That thing is, of course, I've talked about the pricing. Other thing that is important is the length of your contracts. If you're in a business where you sign contracts with your suppliers, with your customers, or even with your staff, let me give you, this sounds a bit complicated, but very important. I want you to understand this. If you're running a store and you're not actually like running it, like you're not always there on a daily basis. If I, as a customer, I keep on coming there and I find new faces all the time, it will be a challenge to me. I may not come there again because people establish a relationship. So you need to treat your staff well. When you take care of your staff, then your staff will take care of your customers. So your staff attrition rate also needs to be constant, because especially if you're not on the ground, if your staff, your customers will form a relationship with your staff or someone working for you, especially if your business is being run by someone else on a daily basis. So when you keep on changing the faces there every day, then it might be a bad sign or signal to me as a customer, and I may not come back again. So those are just some of the ways in which we can retain our customers. But more importantly, customer service is very key. Pricing, very important. Retaining your talent, also very important. Addressing your customer queries when they have customers, they will always have issues, by the way. And then always try to get their feedback as well. Try to engage them. Get their feedback. If at one point they were treated bad, but you handle that situation well, they'll always come back again. So always get feedback from your clients as well, and then understand your customers. Once you understand them, they'll know how to treat them, you know how to retain them, you know what is important to them, and you just address that.
Amazing. It's well put. And there being no other question, I think we have come to the end of today's webinar. From us, we can say, Billy, you've done a spectacular job. You really did your research and you know your material. And for that, we're just saying kudos, and that the topic today was interesting. We learned a lot, and he would like a similar topic. So we are working on that. So thank you so much, Billy, for taking us through the session. And to all the attendees, thank you so much for being patient with us during the opening hours. I see no one dropped the call, and we commend you for that. In regards to your certificates, we are going to send them to you later, and we're also working on the link so that if you need to if you need to access any certificate you've missed, you can just go to the website, log in, put in your details, and you'll get all the certificates. So have a good evening, afternoon, I mean. There being no other business, we are free to leave at our leisure. Billy, thank you once again.
Thank you, Moses. It was a very broad topic, so I just tried to skim through it very quickly, but I hope it raised more interest, and we can do more research on our own. So thank you so much, and may God bless us all.
Okay, thank you. In case you have any other question, you can type it in the chat. We're going to stay behind for 5 minutes to address any concern. Once again, in regards to the certificates, we're working on the link on the website so that when you go there, you're just going to type in your name, your details, and you'll get certificates. Or you'll get all the certificates you've missed. So please be patient with us. We're working to fix the website. Thank you. So I'm going to close the meeting right now. To anyone who attended, thank you once again. Enjoy your afternoon.